So, hi everyone. I'm here with Nick Cherry today, who's the Chief Operating Officer for Phillips and Cohen. And Phillips and Cohen have traditionally been in the probate space, but also do a lot of work in the collection space as well. So, Nick, thanks very much for joining me.
No, pleasure. Good to be here, Chris.
So, what are some of the trends that you've been seeing? You've got quite a specialist kind of area and an area of expertise, both in the probate space, but also in the wider collection space. And I know you look after not just the UK, but other markets as well. What are some of the trends you've been seeing recently?
Yeah. No, thanks, Chris. Yeah, so look, we're fortunate at Phillips and Cohen that we herald from the States with head office just outside Philly, but we have a footprint in 5 different countries, serving 7 markets. It gives us a decent view into what's happening across multiple banking, utility, telecoms, and debt purchase industries. I think one of the misnomers people have always thought is that we only do deceased accounts,
Hmm.
and it's always been back in the States where we herald from. Other specialisms and also mainstream collections have always been 50% of our business over there. So it's quite a chunk of what we do. To answer your question, I think what we're seeing is probably quite a few things. I think roll rates, and these things are published, I think roll rates seem to have leveled off, and if anything, seem to be slightly nudging down. Um, in the States, and this is very much US specific, we're seeing a very big emergence of debt settlement work, which is one of the specializations that Phillips and Cohen's always had, which is the equivalent of debt management here, but much more looking as a short settlement, almost like a variation on an IVA, but slightly less, more informal. So that the volumes of that type of product moving significantly. Still a very big push for debt purchase. We've seen an awful lot come to market. We have part of the group is called Invenio Financial, and we buy an awful lot in most countries, but particularly the States. And very big shift towards people looking to sell earlier, looking to really dig in and sell specialist lots, as well as some still looking to do warehouse debt sales.
Yeah. Do you think some of the debt sale issues been like a cleanup after the pandemic in terms of like people, because it felt, at least here in the UK, people were holding on to debt for a while and there's been this kind of like cleanup that's happened. But I suppose you've got the other dynamic of rising interest rates in the background in terms of like, you've got to get the return from that as well. I mean, what's been your kind of sense on why there's been increasing debt sale and all that kind of market?
Yeah, I think you're absolutely spot on, Chris, in that there were certain sellers that exited the market for a period. They definitely come back to market in force. I think the rising interest rates has also driven more of the fintech style organizations to look
Mm.
at how can they increase their cash flow. We've seen a very much a move away from that exposure to a contingency curve over 1, 2, 3 years towards how can they monetize that asset and how can they use that to drive the funding of their organization. And that's definitely been a big pickup. Earlier sales, not just of the warehouse portfolios that they've been sat on through COVID, but then more looking towards forward flow deals and deals where they can have some cash flow certainty.
I mean the arrears rates, I suppose you talked about earlier there, you talked a bit about some of the earlier roll rates. It feels like, I mean, we were expecting the world to fall apart. We're in this kind of like strange kind of world at the moment, which is you'd expect there's been cost of living, there's been a lot of stress that's on each of the economies, and yet roll rates don't seem to really increase the way we thought they would have done. But what's your thinking around why that is? Do you think it's got to do with the acquisition that took place or lack of acquisition that took place, or we're actually starting to feel like the economy is stable? Do you feel we're in a stable kind of environment at the moment, or
Yeah, I don't want to
who
be the one
knows?
to jinx it, Chris, right? Because and if I had that crystal ball, I'd be a very wealthy man and probably not on this call. But
Yeah.
I think it's interesting because we've been talking cost of living crisis for 3 years really now, and I think we all expected post COVID and most of the Western economies, if you excuse that terminology, really pushing cash into the system to help the consumer. I think we expected that wave to crash and we expected to see delinquency rates rise significantly. And that really hasn't happened. We've
Yeah.
returned to the pre-COVID norms, but not a recessional set of numbers to date. Now, whether that's because people built up such a significant chunk of savings during COVID with all of the relief that was coming from governments and federal and state regulators, or whether it's because people are really using different forms of credit to service one another. It is a surprise. It is a surprise. I know some that we talk to in the industry still think there's a ticking time bomb out there that's got to come home to roost eventually. But really, things do seem to be relatively stable, and that's something that we hear from most of our clients. They're not expecting to see significant changes looking into next year at this stage.
It's quite interesting. We're in the holiday season now, and I was on holiday, and I was sort of chatting with a couple of folks where I was, and we're talking about discretionary spend, and they were actually saying that they'd seen less tourist spending on discretionary items like banana boat rides or whatever it is, right? So is that those it was literally down to that kind of thing. It's like there was less spending on that, and I just wondered whether that was actually a bit of a micro indicator around the money's still there, but people are being quite careful on what they spend it on versus something else. So a banana boat ride is a load of fun, but is it something you really need versus obviously then spending the money on dinner because you need to, feed yourself. So I just wonder if that's almost like the structural change that's gone on.
Yeah, no, I think that's definitely an element. I think also, look, I'm an advocate of this industry's place within the consumer credit world, but I think things like buy now, pay later also, I think, play a role. And I think we need to be careful that we don't drive over indebtedness there. But I think that ability to just spread the cost of very simple things, I think, has helped people manage through. I think for most of our careers, Chris, and we span a few years between us, it's always been that one-off purchase that sometimes pushed people over the edge. And I actually think one of the things that regulators need to be careful of is don't be blindsided by that fact as they rush to regulate these sectors, because actually they are helping people in that hour of need to manage through what otherwise could have been a cash crunch. So I personally think, and I think that's a positive for the industry, I think those types of additions to the sectors have actually helped as long as people remain responsible within those sectors.
Yeah, you raise an interesting point around buy now, pay later, and there being one purchase that pushes you over the edge. But I suppose it's also interesting to look at what is the total amount of those purchases as well. So if you just look at it on the retails, like this single purchase is a risk versus not, and could be the one that goes bad. But then also look at it, what's the total debt load? Look at that holistic piece, which I think the regulators also done.
Yeah, no, and look, I think we all welcome good, thought through, balanced regulation across the financial services industry. And I think that has to be our call to arms, whether it's the FCA or the CFPB in the States. I think that has to be our call to arms for the regulators, is don't do what they did with the payday industry, which was eliminate it. But let's have a sustainable process there, because I think it really does help a lot of people.
Yeah, and I suppose when you look at, I suppose, regulation across the different markets, obviously you have different regulatory environments, of which the FCA, and particularly the piece around consumer duty that's come up as an example recently, or vulnerable customers, those are some of the elements you don't hear to the same extent in some of the other markets, with probably with Australia being a bit of an exception, I would think. What's your kind of view on that sort of spanning across different markets in terms of where is there opportunity, and what are some of the things that you think they should adopt in other markets, let's say from the UK or from Australia, and things that we should adopt here as well? Are there particular areas where we can learn from best practice from elsewhere?
Yeah, I think it's a great question, Chris. I think the FCA, and this is my personal view, and hopefully they won't come after me for saying this, I think they've actually been a very balanced regulator here in the UK.
Yeah.
I think with the now 10 years since they took over as the regulator here for financial services, and there hasn't been anything too radical from them, and they seem to have been a regulator that listens. I think that's quite encouraging for us. I think looking internationally, we see in Germany that BaFin, the regulator over there, is following a similar journey to the FCA here in the UK. ASIC, the regulator in Australia, very similar. There's a much higher concentration within the banking industry in Australia, as I'm sure you know. So there's been a lot of focus on behaviour, and similar to consumer duty and TCF, certainly amongst those big 4 or 5 banks. But I think in the US, particularly, it continues to be very fragmented, and the CFPB, dare I say it, is a very political animal. So it's certainly influenced by it being an election year, and there's even been challenges to its constitutional funding in the States. So there's another lawsuit filed against the CFPB this week, which is something in the UK would be unheard of for us. Unheard of for us. The concept of someone suing a regulator just really doesn't happen. But I think you're going back to your question. Vulnerability is an area that we've not seen embraced to the same extent internationally. I think it's started to gain traction, but in the more mature markets, it seems to be a bit more matter of fact in terms of treatment and appreciation of potential vulnerability at consumer level. There's certainly a big push internationally, and again, particularly in the US, on fair treatment of debtors, but that might be more towards ensuring that certain demographics are not used against them and so on and so forth.
Mm.
And certainly with regards to AI and automated solutions, making sure that there isn't a postcode or zip code lottery where whole swathes of people are being disenfranchised.
Yeah. The fair treatment was where we started way back in the FSA days, wasn't it? Treating customers fairly and those kind of things. It's just interesting in terms of like how we can almost like leapfrog some of the things that need to be done, and doing that in a cost effective manner by learning from the other different markets. One of the things I found interesting was how much regulation then also drives automation as well. So certainly my experience in the UK has been the regulator has come in and said you need to do these things, and that's going to cost a lot of money. So then how do we start to automate some of that? And there's almost like this symbiosis between regulation and technology or technological kind of development that kind of takes place. And when you talk with other markets, you don't necessarily see some of that stuff where it could be like, we're going to put technology in because there's a bottom line kind of benefit for taking cost out, as an example, rather than we've got to put technology in because we need to be compliant. Does that kind of model kind of work with what you see as well?
I think you hit the nail on the head. I think in our industry we innovate because we have to.
Yeah.
Necessity is the mother of invention. And in the contingency debt space, which we operate within for the majority, our clients want to see all those bells and whistles. They want to see the governance layers, the assurance, the controls and systems, and so they should. And so do we, and we welcome that. But at the same time, they're very rarely turning around and saying, how much would you like to increase your commissions by
Yeah,
in
exactly.
order
Yeah.
to pay for all of that? Maybe I missed those calls. I don't know.
I think
But
so.
no, we look forward to that. One or two do, I have to say. There's the odd exception where they do take that more holistic view, but they seem to be in the minority, unfortunately. So I think therefore we have to innovate. We have to find ways to make the technology, the people, the processes continuously more streamlined to be able to still deliver a bottom line.
And AI has been a big discussion, and which I don't really like the term AI anymore because it hides a multitude of different techniques that are out there. But that whole piece around digitalization with these new sort of like large language model techniques or the new sort of like transformer type models that are out there, where do you see that kind of going in, particularly from process management as well? Because there's been a lot of noise about it the last year. It feels like it's quietened down at the start of this year, but it's still there. It still feels like there's opportunity. Where are you guys focusing on case studies where you think that can have transformational kind of value?
Yeah, no, look, I think we see the use across our business. I think we're a people organization and always will be. So where and our very specialist conversations, there's a time where people just want to talk to somebody. So where people want to do that, we make it our job to get that consumer in front of an agent, having that conversation as quick as is possible. Internationally, our hold time is around 19 seconds as an average,
Mm.
without going through 14 layers of IVRs.
Yeah,
So we recognize technology has its use, but actually, if someone takes the time to ring you, speak to them and speak to them quickly and try to help them as quickly as is humanly possible. So I think we are using AI from a driving self-service. We're using AI from carefully with some data analysis. We're using an awful lot in the development and reassurance of our frontline agents there.
mm,
So real-time agent assist. So really driving this type of conversation so that people don't forget certain things that they need to say, certain things that might be mandatory disclaimers,
mm.
and really helping people push in the real time to reinforce that agent skill.
Yeah,
Um, and a lot of training tools as well, Chris, is one of the use cases that we've really pursued heavily. So we've introduced a continuous learning platform. So we can all sit there and I'm sure we all have done and go through PowerPoints when we're in training sessions. But how much of that do you really remember and
yeah,
really take into your future career? Probably 20% if you're lucky. So we've introduced a few AI driven continuous learning platforms, which are 30 seconds to a minute a day, to really focus in on client level and detail level instructions, so that we're really helping people build their knowledge base. And we've seen those things be very transformational. And the AI kicks in to show what Nick's not good at, and it keeps
yeah.
pushing and tailoring the questions according to my areas of development. So quite innovative tools like that, and other ones where we have AI coaches, so that we're trying to increase the speed to competency and the confidence levels when a frontline agent's hitting the phone.
And are you finding that, because we can talk about our business in terms of like how AI can help the business, and it's really augmenting our existing processes to a certain extent, and particularly the back office processes, and making them better rather than replacing team members, as an example, because you still need that human contact. But the other aspect is the customer aspect, or the people you're talking to aspect. Are you finding that their attitude is changing in terms of when they want to call in versus when they want to interact remotely through the internet or through websites or through chatbots, as an example? Is that changing? Has that changed over the last sort of 5 years too?
I think self-service has always been a huge part of what we do anyway. So I
Mm,
think across our business, and it varies from region to region, we see between 30% and 70% of our payments made through self-service,
mm,
which is terrific. Obviously, I prefer 70 rather than 30. But I think you're absolutely right in that people want an immediate answer now. They don't necessarily want to wait till someone wakes up in the morning and logs in, sends them an email response. I think that's where AI and chatbots can really help us, but we have to make sure that we do so in a controlled way. I think we see web chat and chatbots as really augmenting again what we do. They can be used very well to do the ID validation elements of calls and simple questions, dispute handling, validations of debt questions, those types of things. But once you get into more meaningful elements, again, we try to make a human available as quick as possible.
I suppose fundamentally it comes down to how do I, as the customer or the significant person in the account, how do I get to my answer as quick as possible? And for the longest time, that's been by speaking to someone. It used to be by going into the branch, didn't it? And then it's by speaking to someone. And I suppose if you can get some of that sort of digitally, then you can do that. And I suppose it's just trying to understand where is that shortest time to answer to a certain extent. Do you think? What do you think?
No, I think you're right. I think and it really does depend on the complexity of the question and the solution that they're answering. And I think this will move quickly now. We've developed it for 4 intents. I want to make a payment. I have a dispute. I need to check my balance. Very relatively basic things once you're through ID validation, so that we can get that speed to service and convenience for the customer. But what we're also very conscious of doing is giving people off ramps, so that if they get the basic information that they want, they can then move to speak to a consumer. Assuming the time zone is right, they can
Yeah.
then speak to somebody immediately and have a more in-depth conversation. So we're always trying to mix the technology that brings the efficiency with the people.
You guys have invested a fair bit in terms of like data, and I suppose the data that sits in the background, both in terms of that and additional services. What's the role of that, and I suppose in getting the data right to be able to put automation in place? What's your approach been on trying to get the data right and understanding that? Because that influences also in terms of digitalization of processes or automation of processes, because the data's that much richer, isn't it?
Yeah, I think data is a challenge on a few levels, right? So I think one of the challenges that comes with deploying the different technology solutions, Chris, is making sure that people can move seamlessly between
Mm,
communication platforms and that muscle memory move with them, so that
mm,
they don't have to repeat themselves or explain what they've just done online. So I think it's incumbent on us as an industry to make sure that happens, and make sure that you've got the right API and data exchange structures going on across your communication channels, so
mm.
that the customer experience is optimized. But I think you're absolutely right in that you're only as good as your data in this industry. And that's one of our challenges, particularly in the contingency space. We are not in a position as a debt collection partner to a bank to dictate what level of data they give to us. We have to rather
Mm.
take what we're given. So we try to embellish that data with our own and make it as good as it can possibly be. But I think one of our advantages is we can be nimble. We can
Yeah,
deploy data where we're allowed to, particularly in the disease space at consumer level.
yeah.
And there's very few organizations. Most of the banks we deal with might have 6 or 10 legacy systems. And I was talking to someone the other day who said they've got 94 legacy systems
That's a
as a
lot.
bank, which is an insane number.
Yeah.
But I think they said there's only about 10 that they use on a day-to-day basis, but there are 94. And we're able to bring that together into a consumer view,
Yeah.
and be a lot more nimble and dynamic, and help the customer have that one-stop shop solution.
It It does feel like that data view is actually quite a lot of work to be able to do that and bring it together, but it often gets hidden, doesn't it? But it does feel, particularly as we look at AI and segmentation, all the stuff that we're talking about around automating processes, a lot of it's contingent on the data sitting in the background. But it is, like I say, is a hidden piece of almost like basic work that has to happen in the background. And if you've got 94 systems or even 20, it does not make it complicated.
We're fortunate. We say this to the clients that we work with. We can take their data feeds and simplify them. I think one of our challenges, and I'm not sure anyone has an answer to this, Chris, one of our challenges as an industry is in the live debt space. Is if Nick Cherry has two debts from two different companies, we can't mix that data, and they won't let us to from a data protection and contractual position. And clients want to see ring-fenced activity. And we understand that. We will honour all of our contractual and data requirements. But when you view it from a holistic view, ideally, you'd like to have one conversation and one resolution and an infinitely better customer experience. I'm not sure we're ever going to bridge that gap.
Yeah, I'm not sure because it's messy, isn't it? And we want it to be less messy, but you can understand from a privacy point of view and from a client point of view that they want to have that, but it doesn't necessarily lead to the best outcomes. Maybe that's where you look for regulation to be able to do those kind of things, where they can take that bigger picture view. Back to your same point, would any of us want to do that without that? I'm not so sure. I don't know.
No,
We're too nervous,
no.
I think.
Yeah, look, no one's going to challenge their contractual relationships with clients and GDPR and its equivalents globally to be able to do that. It's not an argument we're going to win, but I think that's one of a number of examples where we do our best from a customer experience perspective, but there's always limits.
So where do you think the market will evolve from here? We talked a bit about, I suppose, the outlook for the economy, but also in terms of the collections market. What do you see as like evolving for the next sort of 5 years? Because we've been on a roller coaster, it feels like the last 5 years. As you say, I think it feels like it's stabilized a little bit. Well, there's been a lot of work around digital transformation. Where do you think we go in the next 5 years? What are the key themes that you're focused on, but I suppose you think the industry will be focused on?
Yeah, I think inevitably digitalization is absolutely key. That's here to stay, and I think that's only going to gain momentum from here.
Mm,
So I think that is definitely now a formal part of the landscape. I think there's going to be more consolidation. I know probably doesn't make me popular with a lot of people, but I
mm,
think there's going to be significantly more consolidation within the industry. But if we talk UK specific for a moment, Chris, there's been more flux in the debt purchase market than I can recall for a while,
mm,
driven by the
exactly.
difficulty for some organisations in renewing their facilities and the cost of money and so on and so forth. So I think for new entrants to the market, I think there's probably more opportunity than there's been for quite a while,
Mm,
because that established pack that we've all dealt with and respected for a long time, are on more challenging terms than they've been for a
mm,
long time. I think in a UK specific, I think there's more opportunity than there's been for a while. I think we're seeing more of a move still towards BPO as well. We've walked away from a lot of opportunities where they're looking for very low cost per seat per month type fees and very little interest in that sort of mutual long-term relationship. An emergence of offshoring. It's funny how these things are cyclical. Different countries pop up and seem to be the vogue for a number of years, and then the world moves on. But there certainly seems to be a vogue, and their ability to service from offshore at a different cost. It certainly seems to be a vogue at the moment. How long that lasts, time will tell.
I mean, that's quite a good question in terms of will we move from away from cost into quality and will we move back to quality? You're also saying maybe there's a bit of that cost kind of aspect. And we do go through these cycles of like growth and then sort of, you know, less growth, let's just say, and a focus on cost, growth versus a focus on cost. And it feels like we're going into that. The accountants of us are happy we're focusing on cost and making processes efficient versus almost like that growth mindset.
Yeah, no, you're absolutely right. So as we acquired Ardent Credit Services in Liverpool last year, and it's been a terrific group and a terrific business. But we've had a lot of opportunities in that space, and one that I would never dream of naming, where they came to us and said, "Look, we've got a huge problem with our incumbent. We just feel like the quality of service is not right, the results could be better, and a whole gamut of problems." And
Mm,
then they said, "But this is what we want to pay a month," and we're like, "Yeah, good luck.
yeah.
Let me know how that works out for you, or here's our number and you might get a quality output." So you can imagine where that conversation went.
Yeah.
But I think that's the challenge. I think that's the
Yeah,
challenge.
it does feel like we're going through like that cost conscious sort of looking at how do we increase margin, how do we reduce costs. At some point, it's going to turn around to being like higher quality because it'll be back onto growth. I suppose we just have to wait and see how long that kind of takes.
Yeah. No, look, I think there's a vibrant market out there if you have the right technology set up, the right people. I think what we see as, and if I talk mainstream collections through Liverpool and Ardent, we see as our advantage is very digitally first led solution. We have that ability to do low cost serve, but also we're more than happy to invest in the people side because we think one augments the other. Some people are very happy to self-serve and we welcome that and we make it as friction-free as possible. And other people want to have a conversation and talk for 15 minutes and do an income and expenditure.
Yeah. Nick, thanks very much for making the time today. Really appreciate it. Got some really interesting insights, both in the UK and internationally. So very much appreciated. Thanks very much.
Yep. Pleasure to see you, Chris. Always good.
Thanks.